Welcome to Volatility Trading Strategies. So I do apologize for the long delay between videos here, but I do have my office set up now, so everything should be back to normal. I'm actually kind of a boring person. I have the same work schedule every day, including weekends. I eat the same food every day. I go to the gym or go to the driving range at the same times. So not surprisingly, given my personality, I did set up my office pretty much the exact same way, so at least it'll be familiar. So today's topic's actually been on my to-do list for quite a while now, but I definitely want to do it this week while these huge volatility spikes we've been seeing are fresh in everybody's mind. And it's essentially the difference between losing trades and bad trades. And it's a tricky topic because I know some of you are probably thinking right now, well, wait a second, aren't bad trades just by definition the ones that lose money? Aren't we basically just playing a game of semantics here? But in my opinion, no, far from it. These are entirely different things. And in fact, I believe this is one of the most important concepts to embrace for anybody who wants to have long-term investing success. Something I often say is, sometimes good trades actually lose money, and sometimes bad trades make money. So please allow me a few minutes here to try to illustrate the difference. So let's start here by trying to define these terms, and one of them is actually really easy. A losing trade is any trade that loses money. You enter at a certain price, it goes against you, and you take a trading loss. So that one's easy to define. Bad trades are not so easy to define, but I would say it could be many things. It could be a trade where the market conditions at the time of opening the trade were not ideal, but you did it anyway. It could be a trade that isn't based on any quantitative analysis, and instead, just a gut instinct prediction about market direction. That's never a good idea. It could be one that doesn't take into account proper allocation sizing, and might open the trader up to outsized losses if something goes wrong. That's a mistake. Essentially, bad trades are the ones that aren't open for the right reasons. If things go wrong, which they don't always, by the way, like I said, sometimes bad trades get lucky and end up making money despite being poorly thought out. But if things do go wrong, bad trades are the ones that are indefensible. When the dust settles and you've lost money, there's no way to go back and actually justify the position. It was a bad trade, a mistake, shouldn't have opened it, and nobody to blame but yourself. But losing trades aren't that. These may have gone on to actually lose money, but that doesn't mean it wasn't a well thought out trade based on all the right metrics, possibly with a mountain of historical data to back up that position. And when the dust settles on these ones, despite being down money, you can still defend the choice. It was rational. It was the right move in the moment. And if given the opportunity, you'd do it again in the future. So hopefully that made a little bit of sense, but it's always easier to learn through example. And fortunately, last week, the markets gave us a perfect illustration of the difference between a losing trade and a bad trade. This here is a 1-month chart of the XIV. Now, if you're not familiar with the XIV, I invite you to explore my website for a better explanation. But just as a rapid-fire Cliff Notes version here, the XIV is an inverse volatility product that derives its price based on a rolling of the front 2 months of the VIX futures term structure. Now, this is what the VIX futures term structure looks like. And I can't stress this enough, there are many other things we need to look at in order to make XIV trading decisions, but this term structure is one of several important indicators. Anytime this second month of the future here is higher than the front month future, all other things being equal, and that's important, all things being equal, that may be a tailwind for the XIV. But again, please visit my website for a much more thorough explanation and examples. But here's a 1-month chart of the XIV. Now, last Thursday, the XIV crashed 13.5%, which is a pretty serious single-day drop. It's not the biggest, that actually only ranked as the number 17 single largest decline in the product history, with the biggest so far being 26.8%. And there's been 35 crashes of 10% or more in the short history of the product, so it's definitely inherently dangerous. And we need to make sure we're not taking any bad trades. Losing trades aren't the end of the world, but a series of bad trades may be catastrophic. But last week's 13.5% drop is no small loss, so the question is, for anybody who was in the trade that day and did suffer that loss, we know it was a losing trade, of course, but was it also a bad trade? In my opinion, I would say no, and in fact, it was the opposite. This is one of those examples of a good trade that ended up losing money. My main volatility strategy tracks several indicators, and only when every one of them agrees with one another do I actually take a trade. And in the long run, this has meant that I'm only allocated to trades 45% of the time, and 55% of the time we're in cash. Last Wednesday, we had all of the indicators saying the same thing and flashing a green light. There was no reason not to be in that trade. This is what the VIX term structure looked like the day before. It's completely normal, and the front 2 months were very steep. Now again, this is just one indicator of many that I use, but in fact all of the ones I track were equally positive. Again, no reason not to take that trade. It was a good one that ended up actually losing money anyway. That happens. Now, when I was scrolling through my Twitter feed, I came across a very interesting tweet. Such and such volatility strategy avoided yesterday's XIV disaster, entered XIV at market close. I suppose this was intended to sound clever, but it's exactly the opposite. Claiming to have avoided the crash only to get into a trade the very next day is a perfect example of a bad trade. Now, the XIV went on to lose another 4.5% the next day, but unlike the one the day before, it was both a losing trade and a bad trade. Because this is what the VIX term structure looked like the day after that XIV spike, when the trader said they entered an XIV position. You can see the front 2 months are inverted, which is called backwardation. This is the exact opposite of the situation you want when trading the XIV. That tweet saying they avoided the loss Wednesday and got into the trade on Thursday is essentially saying they skipped the good trade and took the bad one. Results aside, this was not very well thought out. Remember, I said one of the major differences between a losing trade and a bad trade is that a losing trade can be justified. You can go back and look at the market conditions that were present at the time of opening it, and you can make a strong case of why it was taken, whereas a bad trade is indefensible. Well, you saw that the VIX term structure was totally normal on Wednesday, and there was no reason not to take that trade. But on Thursday, it was inverted, it was in backwardation, and the VVIX, which is the volatility of volatility, was at 135. Which is extremely elevated, and it's just flat out wrong to take a trade on that day. But it's even worse than that. This is a backtest going back 7 years to the launch of the XIV, and its performance when market conditions were similar to the conditions that existed on Wednesday, the day before that big spike. You can see it's done very well at those times, and it's not that difficult to justify taking the trade. Despite the fact that it lost money, remember it was down 13.5% the next day, I can say with confidence that I'd do it again if the situation presents itself. It was a losing trade, but not a bad trade. The same cannot be said of the very bad trade decision of being long XIV on Thursday the day after. Same backtest, but this time with conditions similar to that day. Clearly the performance under those conditions has been terrible, and it's just an indefensible position to take. Anybody who entered the XIV on Thursday just hasn't done their homework. Why would anybody want to enter trades when the track record has been so strongly negative? Doing so meant it was both a losing trade and a bad trade. That tweet was even worse though, because it wasn't just some individual on Twitter. It actually came from somebody who's running a subscription service. They're charging money for that advice. Now, it should probably go without saying that anybody who thinks it's a good idea to go long the XIV when the VIX term structure is in backwardation and the VVIX is at 135 probably shouldn't be running a subscription service. But I just use this as a backdrop to illustrate the stark difference between a losing trade and a bad trade. Losing trades happen. It's just part of investing. Sometimes you do all the right things and the market still kicks you in the gut. But if you can justify the trade, and it made analytical sense at the time of opening it, then unfortunately you just take your lumps and you continue doing what you're doing. That doesn't make it any easier to stomach. There's always a financial burden attached to losing trades, and it feels rotten every time it happens. But the best thing we investors can do is make as many good trades as possible and let statistics, probability, and the law of large numbers work itself out in the long run. But bad trades, those are the ones that we need to eliminate, because if you take enough of them, it's definitely going to end badly. Losing trades versus bad trades. These are definitely not the same thing. So thanks for watching. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all 3 of my trading strategies for a full 2 weeks absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you. So go ahead and leave those in the comments section. See you next time.